or loss. Out of the money means this is a situation where as a instrument holder, you are going to make a loss. Like when you are having a call option, you are going to buy, or if you exercise this option, your strike price is more than stock price. So it means you are buying a particular asset in a derivative market, paying a premium than the real asset or underlying value, asset value. So that's why out of the money. And there could be two type of options, two type of style. One is American style option and European. The main difference is when you can exercise, because there will be for with every option there will be expiration date. On expiration date you will have a strike price, then other agreed details. So when you can exercise, so in American option you can exercise any time even before the expiration. Whereas European style option, when you have purchased or when you have invested, you can only exercise at the expiration, not before that. So means because of difference in style, your your option for exercising whether call or put will depend. So this is what we just talked about moneyness. So we can summarize: when it is call option, your spot price or underlying value is more than strike price at the money and out of the money. For both call and put separately, I have kept here. And here, when we talk about NSE, what kind of derivatives we have, basically, rather than classified in terms of derivatives like forward, future, or options, if you go to exchange, it will be classified in terms of asset class, whether it's equity derivative, commodity derivative, currency, or interest rate. Already, all these we have talked about under the capital market. Of course, there are various other terms like, offer of sale when we, discuss about, capital raising activity by, with the help of merchant bank and underwriter. So here, so these are basically option in which you can trade when, in on National Stock Exchange. Now coming to equity derivatives, so here you can see, turnover as on October 28th. This is what status are there. So index futures. So as I said, index future, so stock future, index options, stock future. So all these four are basically your part of equity derivative. Equity derivative. So if you go under the equity derivative, you will find these options. So basically what equity derivatives are, by name itself, the underlying is nothing but related to equity or equity security. And in India, we have two products like futures and options. And this is what, in terms of market statistics on October 28th, 2021. And further, if you go and look at, what kind of equity derivatives, basically, these are stock futures. We have already discussed about futures market where products are standardized, agreement is standardized, and it is traded on exchange. And that's why we can see on NSE. NSE is one of the established exchange. All these instruments are available. And these are the symbol. So this is basically underlying is what? Underlying is Axis Bank stock. So this is your underlying. This is the expiration. And last traded price, volume, open interest. Yesterday we have discussed in when we talk about terminology. So there we have discussed about open interest. Open interest talks about the liquidity or stand. So it includes your how much buy and sell or both side of the market. What is the unsquared or non-squared status. So this is tells you the liquidity in particular stock. And you see underlying value here. Underlying value is 787, whereas last traded price is this. So we can easily relate whether in your derivative market, your your stock future or Axis Bank stock future, is trading at what level and type of liquidity available. And what I have done, I have further gone into the contract parameter. So Axis Bank, this is what we have when we look at the aggregate status of stock futures. So this is what is the details. This is we have seen, and at any point of time, whenever market is live, you will be able to see a market depth. Basically, 5 best bid and 5 best ask prices. So this table tells you the status, and at both the side, what is the total quantity, and other details like volatility and settlement price, other things you can easily get it. And when we look at the intraday pattern, so this is how, because yesterday I have captured, so at 9:33, it is started around 9:15. As you know, Indian market started around 9:15. So by 9:33, this was the fluctuation. This is basically the representing the price, how intraday pattern was for Axis Bank. Similarly, we have index option. So basically here, if you look at this is Nifty index. So Nifty index is basically your underlying. So this is your underlying asset. For underlying asset, what you have is index option. And remember, option is a right, not an obligation. If you are buy option holder, so you have option or right to buy at a given point of time, but no obligation. So here you can see this is a call option, means you are having option to buy. And this is your expiration date for this particular option. So if you exercise, you will have you can you will based on the your price, strike price, and exercise your stock index value, you will have in the money, at the money, or out the money. So here if you see strike price, this is you are buying. Remember, strike price is 18,300 and underlying value is 18,200. So in this case, a strike price is more than your stock price. So this is the situation, means if you go and buy, so this is the situation of out of money at a given point of time, means whenever you go and exercise your option. And if you go and further look at details that we have seen, same way you will have market depth and then other relevant details. And what kind of contract specification you will get. This is basically your future index. So you can see, you can relate FUT stand for future, IDX for index. So this is index future. And N stand for normal market, and then expiration is the date of expiry product. And when it comes to the trading cycle, so this is basically Nifty 50 future contract. And in terms of trading cycle, Nifty contract have maximum of 3-month trading cycle. And 3 months means, remember yesterday we said that for every contract you will have near month, current month or 1 month, next month means 2 month, and far month is 3 month. 3-month contract. A new contract will be introduced on the trading day following the expiration of near month. Let's say here, if near month expiration is 28th of October, so on 29th, new contract will be introduced. Again, it will have these three different trading cycle: near month, next month. So you can think of that every point of time you will have at least 3 contracts. And expiration date, Nifty futures contract expires on last Thursday of expiry month. For example, yesterday we had Thursday. And if we go back and see here, because this is index future, so Thursday of every month is going to be the expiration date, and that's why 28th was the expiration date in our case. And this is your option index. Again, Nifty, it could be call or put option. And it could be, so this is when it is stand for E, means this is European style, means you cannot exercise. If you remember, you cannot exercise before expiration date. So you can only exercise your option on expiration date. If it is A, then it is basically American style. Again, when it comes to the trading cycle, have 7 weekly expiry contract and 3 consecutive month contract, like as we have seen. And also when it comes to expiration, Nifty 50 options. Remember, we are talking about option. Monthly contract expires last Thursday of expiry month. And weekly contract expires every Thursday of a week. So Thursday is going to be the day when your option will expire. This contract, futures contract, we have yesterday seen that on NSE it was introduced in 2001, and so this is basically a stock future. So this is related to particular stock, underlying is particular stock, and there are 180 stock as on today. 180 stocks are there, is identified by SEBI, and for these stock you can find this kind of instrument, derivative instrument. And say for stock futures also we will have 3 cycles, 3 contract trading cycle you will find: near, next, and far month. And it expires, the expiration date will be the last Thursday of expiry month. Basically, these are whenever you are going to trade, or when you are going to analyze, these details will help you to understand. And these details will vary from one country to another. Remember, in India we have Thursday, some country it may be on Friday. So you will have to see for country specific how all these specifications are. In terms of contract specification for stock options, so earlier we discussed about index future and index options, and now we are talking about stock futures we have just discussed, and this is a stock option. And again, option type CE is call European, put European, E stand for European style, and 180 stocks because we are when we are talking about derivatives, so stocks that are for which futures are available, definitely options, if exchange already allowed, so option will be also available. And if you look at in November 9, stock futures were introduced, and in July options were available. The options were first introduced and then your futures. And in terms of trading cycle, 3 month at any given point of time, you will find contract available for trading, and then contract expires on Thursday. Now, whatever we have discussed so far, these were related to equity. But on exchange, basically, if you go and look at NSE, so we also have commodities, because our initial discussion on example that we have taken, where some trader wants to get into a contract with farmer to buy and sell pulses. So you can think that there is lots of opportunity, lots of market for commodities. And that's why we have commodity derivatives, which are very good source for market. So in India, you will find future and options are basically derivative on exchange. So we will see about details of these commodities. And NSE launched derivatives on commodity on in 2018. So before 2018, there was no this kind of option in which you can trade. And currently, futures on the commodity are available on bullions and energy. So basically, three classifications are there: agri, bullion. Bullion, when we are talking, means we are talking about precious metal like silver, and then we have copper, gold. So these are basically commodities. All are commodities in general, but if you go in detail, we can further classify them. So on NSC, these are the derivatives. This your oil, basically all these oils are related to your energy uh, derivative. Copper, gold, metal are basically your what we call precious metal, or we call it bullion. So it is in that category. So here, as I said, you can find these subcategories. Agri means we are talking about cotton and those kind of agri product. Base metal contract means generally copper. Copper is included in this. Bullions means your precious metal, silver, then you have gold, and in energy you have crude oil. All two category of oil we have talked about. These two are basically your energy contracts. So means you can easily find. So in energy contract, you can see this is basically your crude oil. This is your underlying asset, your 100 barrel, whatever the units. This is basically we can call unit or lot size. We have seen that whenever we buy or sell in derivative, there is a lot size, minimum size that you will have to trade or you will have to consider for your trading activity. And in case of base metal, you can see copper is your what you call asset, underlying asset, and this is the minimum unit you need to buy and sell. And in terms of bullions, you have gold, standard gold, and you can have, because this is option, so you can have call and put. So here you can see for same contract, same maturity, you have almost 20 rupee difference between pull and put and call option. And we have dedicated, in India, we have dedicated exchange for commodity. We call it multi commodity exchange. And it was started in November 2003. Because generally, when NSE started in 1996, around 1996, the major focus was on stock or derivative, your debt instrument. It was not considered that it will be doing also allowing derivative product. So with that assumption, in 2003 MCX was introduced, and later on NSE also allowed trading for derivatives. And if you go to MCX website or MCX portal, you will find all these instruments. So basically these are the commodity index. Like in case of equity, we have seen stock as an asset, and we have seen index like Nifty. So this is basically index based. So this is based on bullion, this is metal, and this is energy. So these are basically index based instrument. And these are in under the bullion, these are the options available, means these are various standard option like gold mini. So there are well defined definition what kind of gold will be called as gold mini or gold metal. In base metal, these five metals, aluminium, copper, these are considered for the trading activity. In oil, we have these two categories, crude oil and natural gas. And in agri commodity, cardamom, cotton, crude palm oil, kapas, mentha, and rubber. So these six commodities are available on MCX for trading. So because MCX is a kind of exchange that provides you for trading in commodities, and commodities having these different subclasses. And apart from that, we also have currency derivatives. So far, if you remember, we talked about equity derivative, we talked about commodity derivative. Now this is third kind of derivative is currency derivative. Means its underlying is basically currency or currency pair you can call. So basically these are the contract that confer the right to buy or sell foreign currencies at a specified price at some future price. So this is you can easily understand that in this your underlying asset is basically commodity. And NSC on NSC, it was started in 2008, and it was started with US INR currency pair. And then later on Euro, Pound, and Japanese Yen currency pairs were introduced, and options were started trading from 2010. So right now, if you go and see the options trading in Euro, Great Britain, and Japanese Yen was introduced. Earlier it was not there, and then in 2018 it was introduced. And cross currency future options contract on these are introduced in 2018. Remember, one way of representing currency is your home currency. So this is home, and this is other country currency. So this is one way of representing currency. When we say cross currency means both the currencies are different currencies. Here you can see Euro, US dollar, or Great Britain pound, USD. So here your home currency is not there, but because many times you will find fluctuation in non-home currency may impact on your home currency, and that's why these kind of future and options in cross currencies were introduced. So only these three cross currencies are available basically. And if you go and look at how these options are available, so here you can see currency pairs in INR USD and last traded price 75 rupee, almost 75 rupee per dollar. And you can see other details, open interest. People are involved in this kind of contract, so that's why we have high liquidity in that. So there are, cross currency pairs when we talk about your pound versus USD, USD versus Japanese yen, and so all these are available, and you can see, how much trading is happening. But majorly you will find trading in a direct currency like these currency pair USD versus INR, because as a trader or as a market participant who is trading from India, basically more interested to know home versus international currencies. So here you can see these four currencies are available, and there are various lot size that can be used for trading, and the tick size is in this market is basically 25% of 1 paisa. So like basically when we convert into paisa, this is 0.0025, and it is settled in T plus 1 in a T plus 2 settlement cycle is followed on NSE. So here you can see a lot size about various currencies when we talk about currency option, and options are available in 25 different strike price, 12 in the money, 12 out of the money, and 1 at the money, and 20, so 12, 12 plus 1. So basically you will have 25 call and 25 put European option. Weekly options expiring every Friday. In other case, we have seen as Thursday. Contract are settled because this is related to money or currency. That's why here role of RBI becomes very critical. And same way you have other details. It is liquid and monthly options expires 2 days before last working day. So these details are already there. And these are the contract specification, like whenever we talk about futures, and this is how your tick size would be, and your all these details you can compare with other pairs. And this is about the option, one contract, one unit. Here unit of trading, you can see it's 1,000. So this is basically lot size we are talking about, and there is no difference. Your tick size in future and options contract is 25% of 1 paisa. So what is the currency swap? So basically is a kind of agreement. This is a kind of swap, by term, we know what is this swap? Exchange. So swap is basically an agreement between two parties to exchange asset or set of financial obligation or a series of cash flow for a specified period of time at predetermined interval. So when we are saying currency swap, so you can think of a situation where one person is in US, another person in India. They are doing some kind of agreement. to swap their currency. Why they are swapping? Because there is a risk, forex, for your exchange rate risk. How it happens, we will see one example. So basically they include here a spot and forward transaction in one agreement, and are generally customized transaction based on the party. A party can reverse or unwind their swap position before the end of term by cancelling the agreement and delivering a final difference payment to the counterparty. So means in swap, if someone is closing the position before the expiration date or agreement date, then the difference, whatever difference would be there at that point of time with respect to international benchmark, with that, after settling that, a party or counterparty can leave this kind of agreement. So here we can see one example. So first we will read this and then we'll see this particular case. So suppose that there is a US firm A and you have another Indian firm B. So firm A wants to start a business in India for which gets 10 million in form of loan from a US market. So this company has taken loan at, you can assume that at this rate, and total amount that company has raised by a company has taken loan is 10 million in the form of loan in US, and exchange this amount with Indian firm. Let's say 10 million is equivalent to 45 million. It means you can assume that 45 rupee per dollar kind of rate. So if it is exchanged by a company B, then they can bear, so what will happen? So if this kind of exchange has happened and both the parties, so what both the parties can do at future, so this is, let's say, happening, this is happening at t is equal to 0, and based on their swap contract, let's say at t is equal to t, they are saying then we will exchange, or after the utilization, then again to settle it, because at the end it is going to be paid back to the bank, and of course interest and whatever is there need to be paid, but this amount they can exchange, because if this company consider do ignore the fluctuation in the US Indian market, then probably if Indian rupee appreciate, then 10 million that company wants to take it back may be difficult, but by getting into the currency swap, company can ensure that there won't be any risk because of change in the exchange rate. And that's how here you can see that entire transaction can take place between these two companies, and they can hedge their risk. Similarly, we have interest rate derivative. So in interest rate derivative, because here you are not two parties are not going to exchange the what we call exchange the currency. They are only going to exchange with respect to interest rate. So in India, we have interest rate, two type of derivative: interest rate futures and interest rate options. So you can easily relate that how these options are basically their contract. And in terms of instrument, generally you will find these four instrument. Basically, these four interest rates are used. One is GSEC futures, GSEC option, and these are the benchmark rates. Remember, benchmark rates means if there is swapping of interest or interest rates, then there should be some benchmark. And these benchmarks are going to be used, remember. Already we have talked about MIBOR and this kind of thing. So Interest rate swap can be of different type. Like interest rate swap, when we say this is a kind of forward contract in which one stream of future interest payment is exchanged for another based on specified amount. So that specified amount is basically a notional amount which is used for exchanging the interest rate. And you will find these three type of interest rate based on coupon swap. This is some kind of fixed interest swap, because here you can see that interest rate could be floating or could be fixed. So one party may want to use floating exchange rate and want to exchange with fixed. So one party may be taking so this is, let's say, party one, and here is you have another party, counterparty party two. Party two says that I have a loan of, let's say, loan of 10 million at floating rate. And another company says that I have some loan at fixed rate from the bank, but I want to swap it with another party that is involved in floating rate. So they both parties can get into this kind of interest rate swap. So when we are saying floating rate, let's say benchmark is MIBOR. So so MIBOR or LIBOR plus, let's say, 2%. So this is the floating. So if MIBOR rate or LIBOR rate change, this floating rate will change. And here, let's say, fixed is around 10%. So what will happen at the end of the contract, at the end of this, or sometimes it is happen on a regular basis. So let's say at any given point, total amount, see here, total amount is 10 million. So 10 million becomes your principal amount. And here it is 10%. So for any point of time, if let's say MIBOR is at given t is equal to 1 is 8%. So it means both the interest rate are equal. So no party needs to change it. Sorry. But if interest rate here, let's say, goes to 5, MIBOR and 2%, and this remains 10. So because these two are swapping. So what will happen, because P2 will prefer to take a position in fixed. So in that case, whatever difference is there, different, if you see 7 and 3%. So 3% into this much amount P2 will give to P1. Basically, based on the interest rate variation, this swapping on notional amount or this principal amount will take place. So this you can easily relate that P2 and P1, though they have taken loan on floating or fixed rate from respective bank, but when they get into interest rate swap, they can minimize their interest rate risk. So here example, like as I have discussed, you can see. So there are certain advantages. First is advantage is the effectively translate floating rate into fixed rate or vice versa. Second advantage, both the parties are structured at separate contract, distinct from the underlying loan agreement. One party had fixed, another party had floating rate loan, but by swapping, they can have distinct characteristic of their agreement. They are applicable to new as well as existing borrowing. So both party can go into the swap contract, interest rate swap contract at any point of time. And these are basically hedging instruments. So these are treated as off balance sheet transaction because they are hedging. So they need not to show in their balance sheet. So We have seen there is a difference in currency swap, basically foreign exchange agreement between two parties, and they are going to exchange it one currency with another. In interest rate swapping, the exchange of interest payment. Remember, as I said, that if my power plus 2% is coming 7% and another fixed is 10%. So difference between these two will be 3%. So your one party will net, the party that has taken floating rate, that party will get 3% into notional amount as interest payment under the interest rate swap. So here you can see there are variety of options, and these option may also create kind of risk in the market. So other type of derivatives, because weather is something where you can speculate, you can have various type of predictions. So weather derivatives are available. Freight derivative. A freight derivative basically instrument for trading in future level of freight rate. Credit derivative, credit credits option, credit swap, credit default swap. You may have heard that if any company probability is there that company may default, then credit default swap can be an instrument or instrument to avoid that kind of risk. Now we will, quickly spend some time on valuation technique. I know there are lots of things. If you go and read John C. Hull book, you will find lots of calculation, because derivative is a kind of subject where we have lots of mathematical derivation and calculation. So, but considering our particular course, we will just look at the formula that can be used. So first we will look at the valuation of forward contract. Remember, forward contract, non-standardized contract. We are assuming that S0 as spot rate today, F0 is a future or forward price, T is the time to maturity, R is risk-free rate of return, I is income received from the asset. Like when we talk about a stock, dividend. Dividend could be one kind of income. Y is yield from the asset, and E is its exponential function that we use. So when there is no income, for example, for particular stock, if no dividend, stock is paying no dividend, or when we talk about debt instrument, there is zero coupon bond, because it could be your contract could be in and any of these instrument as well. So if that is the case, we can use this formula to get the forward rate. Here if you see, F0 is your forward price or futures price. So if current price is spot price is 50, your risk-free rate is 7%. Your T, if you look at T, maturity is half year, 6 months. So your theoretical forward price should be 51. If there is any income payment from your instrument, then it should be subtracted here. Here you see, without income, we assume that I is equal to 0, and here we have some value. And price for forward contract with known yield paying asset. For example, if it is bond instrument or debt instrument where yield is known, yield is 3%. Here you see 3%. So for that, this formula we can use for calculating the forward price. Now, looking at the futures contract, basically forward we have talked about. This is about futures contract related to your commodity. So for valuation of future contract on commodity, First, we consider the impact of storage. Remember, when we are pricing any commodity, we should look at the storage. Any commodity you can think of. So that's why these are the key factor. We consider the impact of storage on futures commodity price that are investment assets. A storage cost can be regarded as negative income. Remember, this is a cost. Storage is a kind of cost. So it is a negative income. And if we assume that C is the present value of storage cost, that will be earning during the life of contract. So we can calculate the forward rate as current price plus this is the cost, and that's why it should be added so that we can adjust it for cost, and e to the power r into t is the holding period. So this is how we can calculate for this kind of future contract. And if the storage cost of net income occurred and is proportional to the price of commodity. So like in previous case, we have seen here versus in this case, same kind of situation we can have also here. So the only difference here we will have is rather than this expression, we will have cost function with your risk-free rate, where C denotes basically the storage per annum. So this is in terms of rupee. Remember, this is in terms of rupee. This is in terms of rupee. When we represent this in terms of percentage, then we need to adjust our formula. And this is what everybody knows what is binomial option pricing. So binomial option pricing means we are considering a scenario where there is a kind of binomial, buy or sell, or going up or going down. So that kind of condition is there. So here you can see that this is spot rate, and it may go up or it may go down. So to get it, we will take this example. So this is one step binomial model. Why one step? Because we are considering that our test framework is this. This is T0 and this is T1. Only one time period model we are considering. And then later we will go and see how we can expand this. Sorry. So here basically remember, this is option. So in option, you will have one, your underlying or derivative product, and you will have your underlying asset. So you will have two instruments. So let's say we construct a portfolio long position in normal stock. Normal stock means your what you call underlying asset, and short position in an option. Assume that the current price of a stock is S0 and current price of option on stock is small f. Suppose option gets mature on time t, and during the life of option, value of underlying may move up, so S0 up, or goes down. So this, it may go up or it may go down. So there are two possibilities, and that's why we are saying this is binomial option and only one time period we are considering. The percentage increase in the stock price when it moves is this, and the percentage decrease is 1 minus d, and that's why d is, we are assuming it should be less than 1, otherwise this will be a negative value. Similarly, we expect payoff from the option is FU, which is S0U, and payoff from this is FD and S0D. So this is basically one time period model where it may go up, it may go down, and based on that, we can calculate what would be payoff. So basically, if we are assuming that this is a kind of portfolio, so if you want to calculate this, so if stock price goes down and then payoff from the portfolio will be this, we can directly relate with this. And also for another case this, so payoff should be equal because we are not considering any external factor. So with this relationship we can calculate this delta. So basically this delta is what? Delta is implied ratio of change in option price to change in the value of stock. So basically value of stock is nothing but your asset, underlying asset, and this is value of price. And as we are saying that your option that you are we are analyzing here is created because of your stock, because of underlying asset. So there is no reason to believe that both should have very different uh, different characteristic, and that's why based on that assumption this calculation is being done here. So so we can use this, and if you substitute in our previous model, so we can get the F value for this kind of setup, one time period setup like this, and the price could be this price for your one time period asset. One example we have. So how much time? I'll take 5 minutes and then we will conclude at least today's discussion. So here one example we are taking. Current price of stock is 30. It is known that at the end of 3 months it will be either 33 or 27. Strike price of call option of this stock is 31. After 3 months, if stock price turns out to be 33, the value of option will be 1. And if stock price is this, then value of option will be 0. So when we look at the calculation or this particular problem, so this is what we have. So F we can calculate using that expression we have seen earlier. So with that, this kind of scenario can be estimated. Here you see how we have calculated F value. We are calculating from this expression, and value of P is we are calculating from here. So basically this is one time period model, and there could be two time period model, and here you see your this function will keep on changing. So in derivation I'm not going because our objective is not to restrict only one time period or two time period model, but we want to get into a generalized form, Black and Scholes uh, option pricing model. So, so what Black and Scholes option pricing model suggests? It suggests, if we have, we follow a Wiener process, or we follow some kind of, process where prices are changing every, or probability of, change in the price of, assets are there in every time period. How we can generalize it? How we can arrive at the, price? So you can look at the derivation. It it uses certain assumptions. So you can look at assumptions. So we can this is what final outcome of your Black and Scholes pricing models are. So this is the price P that we just price of call option and put option. So we can calculate this, and this is basically in your risk management or derivative. you are going to spend lots of time in Black-Scholes model, pricing model, and then there are other versions. Version means over the period of time people have suggested improved improved models. So they have made certain changes and try to see whether pricing model can further be improved. So that you will be seeing in if you take this particular course. So this is the last slide. So we can see that of course derivative market provides you a good option for hedging, but at the same time there are various issues. For example, it allows speculation in the market, and because these instruments are risky, we are not sure whether it will give the desired benefit or not. So that's why the risk is already involved. It creates instability. It creates a kind of price instability because chances are very likely that your price that we observe in derivative market with respect to your capital market or in your underlying asset, if these two, you will find these two many times vary. And that's why when volatility transfer from your one market to another market, it creates a price instability. It also creates displacement effect. Why displacement effect? Because chances are very likely that derivative may substitute the or impact your price discovery process for the underlying, or it may substitute or underlying itself. So that risk is already there. We call that kind of effect as displacement effect. Of course, it has created burden on regulatory body. Now regulatory body needs to think of stringent norms across all these instruments. And also there are various evidence where we have seen that derivative markets create some kind of noise in an entire market, and that leads to adverse situation for various asset classes and instruments. So this is what I plan to discuss. I have planned to discuss in today's session. So Forex, a discussion on Forex is left. So what we will do in next class, I'll quickly cover Forex, and then immediately after that, your presentation will start on your given assignment, group assignment, and I'll be sharing the sequence. So we will, there will be 10 to 15 to 20 minutes, minimum 15, maximum 20 minutes. Every group is going to present their work, and then their work will be evaluated based on their submission, their report, submitted report, as well as their presentation. Yeah, and any question, if you have any quick question, I can take it. Otherwise, we will meet next week. And there will be one more quiz probably next week. It will be MCQ based. Whatever we have covered in last few weeks, that will be the part of your MCQ. No question. So I'm concluding today's session. And if you have any other question related to what we have covered and about your assignment, you can post it on MS Team. I'll definitely answer to your question. Yeah, thank you.